Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for May 31st of 2021. Please see our disclaimer for important information. As we get started this week, we have some data, as we usually start off with, regarding the coronavirus and the pandemic. We have the COVID tracker up on the upper hand side of this chart. You can continue to see both of the 7-day moving averages for daily deaths and new positive cases continue to go down. We're at about 290 million doses administered. And the data, at least with regard to the U.S., continues to look really good. Some states are now up almost close to 75% inoculation. Other states are lagging behind. We also know that for sure that there are pockets across the globe that are well behind the curve. But we're at a point now in the vaccination process, at least with regard to the reporting and the relevance of this kind of information in this chart pack, that what I'm planning on doing going forward is condensing all of this stuff into almost like a semi-monthly update that lives on its own. So the folks that want to have the updates on the coronavirus as we continue to be vaccinated will be able to get that, and I'll have some other charts that we can deliver in that regard. But we're going to begin to migrate this Charts of the Week away from a coronavirus update per se and kind of get into the economic and market related charts that you all are tuning in for. So here's a chart from McKinsey Consulting, and it talks about the path to herd immunity. And this is pretty interesting, and it's a part of an essay and an investigation, which I thought was interesting reading. And what it does, what it tells us rather, is that it looks like we're going to achieve an earlier peak for herd immunity just because we've got the cases that have been reported. Those people have some form of antibody against the virus, and then all of the folks that have been inoculated against the virus, and then those who probably have antibodies and probably don't realize it because they didn't know that they had the virus in the first place. But their assessment is that we achieve herd immunity in kind of this traditional sense in the third quarter. And however, there are caveats, and these are fairly strong caveats, that we're going to potentially see some variants in the virus, which is going to complicate the ability to achieve and maintain herd immunity, and is also going to challenge our pharmaceutical industry to come up with reformulations that are going to address these variants. And I think we've all heard about the prospect of having booster shots and things like that, and of course none of that's been set in stone yet. So that's kind of a moving target. So as we sit here at a point where we're beginning to be more comfortable getting out without masks, 100% occupancy at sports venues and things like that, we just need to understand that there's going to be little hiccups along the way that we're going to have to navigate. And this piece from McKinsey definitely highlights that. Here's our high frequency data. Again, mostly positive across the board here. Steel production down slightly over the last week. You can see the areas that are hitting new recovery best highs in the shaded level under the level column. Jobless claims, trending well. TSA checkpoint data hit an interim high, as well as supply of motor gasoline. And we're getting into the peak travel months, and of course Memorial Day weekend being a long weekend in which we celebrate the service and the sacrifice of our men and women in uniform. It represents a peak travel period, and so we would certainly expect to see that data continue to rise. And in fact, TSA checkpoint data is up almost 22% in just the last month alone. But box office receipts looking good month over month, 31%. Even the weekly data is trending pretty nicely. We know that commercial flights are beginning to pick up. The supply of flights being put back into the inventory is picking up, and open table restaurants up 12% over the last month. and almost 3% over the last week. Really, really good data here. And so we'll continue to monitor. Well, before we exit the discussion on the pandemic completely, I wanted to offer this slide, which is some data compiled by Haver Analytics from information that comes to us by the Census Bureau, and it shows you the percentage of adults living at home and how this number really shot up during the pandemic. It's kind of interesting to see this, and obviously there was a lot of dislocation for a lot of families, incomes and jobs, et cetera, et cetera. But what's notable here is that this is a trend that's been in the making for a long time, actually, and it actually predates the global financial crisis when we began to see younger generations living at home or moving back in with their parents, and how this number is really accelerated by really almost 2 to 3 full percentage points during the pandemic, but after having leveled off at kind of that 31 to 32% level. But this has implications far and wide, I think, for household formation. Obviously, younger generations are working more, perhaps not getting married until later, and then that has implications for having children and the replacement ratio in our population, and also the demand for new housing. As we know that housing prices are going up everywhere across the nation, and especially in pockets that are witnessing strong net migration like Central Texas, where it's very hard for younger folks to get into a new starter home despite the fact that we're still at very low mortgage interest rates. And so the affordability issue remains in question, and it'll be very interesting to see what happens to the data in this chart after we pass through this pandemic phase, and if it stays high or if it begins to come back down again. Now let's jump into commodities. There's a lot to talk about commodities here, and we know that commodities are high, and we've got an inflation chart that follows this, especially with regard to commodities. But what we see here is the commodity price index itself has clearly moved higher. We talked ad nauseum about a lot of the hard commodities, whether it be copper, steel, iron ore, and those types of things moving higher, as well as soft commodities, soybeans, corn, etc., cotton, and we've seen that entire basket really shoot back up as the economy has kind of almost moved faster. Demand has moved faster than the supply mechanism can react to, because there was a lot of shutdowns during the pandemic, and then demand really kind of came back a lot sooner than a lot of folks expected. And so we have this choke point now, and that's driving these prices higher, and you can see that manifested in the price index. And if you look down below, what this tells you is the momentum indicator. And so this is essentially a sign that what we have is overbought. And if we look at overall inflation and the influence into overall inflation from the commodity basket, we have seen some influence there now. I think we'll continue to see some influence. I think there is some merit to the conversation that some of these prices will be transitory, and we'll look at that in just a minute. However, I do think that we'll maintain a higher overall level of inflation going forward than we've seen in the past. It just won't look like it is now. But you can see on the bottom that I think from an investment market standpoint that we're at an overbought situation here on the commodity basket. And here's that inflation chart for commodities that I just mentioned. And so this is a compilation from Fitch, and these are estimates put out there. And you can see in the blue, which represents the 2021 forecast, and then the red for 2022. And you can see that, from a annual change, if we're talking about 2021 and the rapid increase that we've seen in a lot of different areas, as you kind of read along at the bottom part of this chart, that there's some fairly strong price responses and some of these areas. I mean, look at WTI crude, natural gas, and then over on the far right, you've got wheat, palm oil, soybeans, and iron ore, and so you've got a lot of strong price response in 2021, and I would expect, as the estimates do here, expect that that's going to reverse itself a little bit in 2022, but not necessarily giving up all the gains that have been made thus far this year. Now we transition over to the consumer side of the inflation equation. And what's interesting and very notable in this chart comes to us by the Philly Fed surveys and presented in a research piece from FS Investments, is that the University of Michigan 1-year forward, this is a consumer estimate. This is what consumers think is going to happen with inflation. And this is 1 year forward. So this is as of the first quarter, what consumers feel like is going to happen next year. And then down below, you've got the Philly Fed and the 1 year forward as well as the 10-year forward estimates. And so what's clear here is that you've got consumers that feel that there's going to be much more inflation than the academics do. And we'll just have to see what plays out. And I would say that the large spike in the consumer side is probably not well-founded. Consumers tend to react a little bit emotionally, and I think that's embedded in the data here. But I think somewhere, I think there is certainly merit to what the Fed is coming up with, and that migratory path for inflation is going to move up. And I think especially if we look over, certainly the next 1 year, but more so over the next 5. And what's interesting here is that they're even predicting, that migratory path moving higher over 10 years, which is extremely hard to predict, but it is notable. And here's the employment cost index, and it remains subdued. This is a number that we've been watching really, really closely as labor has been tight in a lot of service industries. And I'd say it's been tight in some other areas too. The skilled labor components, I think people are really excited about reopening and even the professions and looking for skilled talent has been a challenge. And but certainly on the semi-skilled and unskilled side, restaurants that need busboys and et cetera, they're offering incentives just to come in and interview. At some point, I do feel like that's going to have an influence on this ECI number on the year over year, but so far it really hasn't. And we see that little tail up on the far right side of this chart, but we're really going to have to monitor that because that could be a real sticking point for inflation into next year. Here's our gold price. So we've seen gold level off, but it's come back, and some of this has to do with the path of interest rates here as of late, and I think it has a little bit to do with inflation, and I think it also has to do something with the fact that the cryptocurrencies, which are kind of what people were beginning to call the new gold, the luster has come off as we've seen some really radical price sell-offs in some of the Bitcoin offerings, as well as some of the other cryptocurrencies. Here's a chart of iron ore futures, and it tells a story that I've been talking about, that we've had such a large spike in some of these commodity components that have begun to come off their peaks, although they still remain elevated. And certainly iron ore futures is one of them. If you look at where this chart starts, the data series begins essentially a year ago. And obviously we remain extremely elevated from from that point, which is arguably depressed from where it was at the end of 2019, but still we're above that point. But the good news is we're coming off the peaks on some of these things, and I felt like iron ore was just one area that was very emblematic of what's going on in a lot of the areas of the commodity basket. And I think this goes back to what I said about the fact that the influence into the production price mechanism from these commodities it's going to be elevated, but it's going to roll over. I think some of these elements are going to be transitory, and I think it's in evidence here. Here's our trade-weighted dollar. This is the trade-weighted dollar index, and you can see the dollar's going back down as we have witnessed strong rhetoric from the Fed that they're not going to be raising interest rates, which is not only holding down the short-term rates, but it's having an influence even as we have increased inflation expectations. It's not moving the 10-year Treasury yield that much higher. And so as a result, even though we see a lot of negative real rates across the globe, that on a relative basis, that's put a kind of a ceiling of sorts on the dollar as of late, and we can see the dollar on a trade-weighted basis fall off a little bit. I'm going to talk about the housing market a little bit. We haven't really shown a lot of data here lately, but this is pretty compelling. New one-family houses sold. The numbers are well above their historical trend lines. If you go back to 2014, come off a little bit, which is not atypical. You can see there is a modest seasonal trend. You get through May, June, a lot of activity that tends to happen like right before the end of the school year for mobility purposes and whatnot. But the good news is here that the data remains high. But what's not being told in this chart right here is the fact that we're seeing a really, really strong increase in prices. Here's the Conference Board Home Buying Plan Index, and you can see that this is what I was talking about before when we showed the chart about the younger generation increasingly living at home with their parents, and this has something to do with that. So you've got buying plans for new homes, and the issue here has a lot to do with the fact that prices are really high, and even though mortgage rates are low, the ability to buy a house has become more challenging because in some cases you have to come to the table with a lot of extra cash that people simply don't have right now, just because of the supply and demand imbalance. Here's our Shiller 20 city composite as well as a national composite. And they both tell the same story. Charts look very similar, but what we're dealing with is essentially in the 20 city composite, which is kind of the 20 largest cities that you had basically a 13% increase, very strong price response. And then you saw basically about a 13.2% increase in the national index, which dovetails out. That's a much larger subset, but it's really compelling. And I think in many respects, this rate of gain is just simply unsustainable. The question is, when does it really slow down? And what kind of governors is it going to place eventually on our economic growth? Here's our chart from Redfin, which tells this story that I mentioned a second ago, that buyers have to come to the table with a lot of cash. And we have seen a dramatic increase in the number of homes that are selling above their list price. And that's noted in red here. In case, sale to list price ratio down below, it's almost 102%, which is phenomenal. And then the 4-week average of homes sold above their list price is now almost 50%, and so this is causing this choke point here for buyers that want to perhaps achieve mobility, or people that are in rental situations now that want to move into a purchase type scenario, that these prices have gone up, and with lenders only lending to the appraised value, a lot of these folks are being compelled to have to come to the table with a lot of cash. Here's our Global Uncertainty Index from the Economist magazine, and I thought this was really interesting because as I've been talking about this global recovery, if you will, the synchronized recovery, where not all areas are growing at the same pace, but all areas seem to be growing despite the fact that the vaccination process on the pandemic is a bit uneven across the globe. But what you can see here is that the uncertainty of things as it relates to the forecasted and actual economic data has really dropped off. And without a doubt, it was at a fever's pitch last year because nobody knew which end was up. But as we head into the summer months here in 2021, that index across the globe has really dropped. And so when uncertainty decreases and certain relative certainty increases, you get a lot more confidence, you get a lot more capital spending. Business owners are more interested in committing risk capital to growing their business. You see consumers be a little bit more confident in their purchasing habits, et cetera. So there's a lot of tangential benefits to having lower overall uncertainty across the globe. We get into the stock market here. Here's a ratio of the IWM, which represents the Russell 2000, against the S&P 500. And you can see the small caps have really struggled as of late in relative terms to the S&P 500 after having been really strong. So in other words, what we've seen is a lot more volatility in small caps, which still have relative value in my opinion, but it's been interesting to see that the sell-off or the increase in volatility rather has really been pronounced in that small cap area. Here's a chart plot of the market reaction, the S&P 500, and in dating back to the global financial crisis and then overlaying where we are with COVID. Now we know the emergence from the global financial crisis that, when we got not quite a full year out of the GFC, that we had a fairly decent correction. And so you can see the overlay here. Again, not a one-for-one correlation, but what it suggests, I think to me, and something I've been looking for some time, that's why we've added some portfolio insurance type items into the equity component of our portfolio allocations, is that something like this, I think it could happen. There's a lot of enthusiasm. Obviously, in the last chart, there was, the global uncertainty index has dropped considerably, but we just need to be prepared for a bit of a correction with the market having been so strong. Here's the short interest ratio for the average S&P 500 stock, and it's really dropped. And what this really means that there's an incredible amount of confidence. And surprisingly, with the market move that we've seen, that there's not, you typically see a spike in short selling when speculators feel that the market's a little frothy and is apt to drop, so they can profit on that drop. The fact that you don't see that tells me that there's a lot of confidence in the market. Again, despite this gradual rise that we've seen, so it almost kind of, it sounds like I'm talking out of both sides of my mouth and showing you that chart with the overlay with the global financial crisis, that yes, I do feel like there's the potential for some type of a news item to spark an interim sell-off, but then the market then kind of continues an uptrend after that brief sell-off. But this would tell you that there's a lot of confidence and a lot of complacency in the market right now. Here's our earnings expectations, and you can see that as you transition from left to right, and this is the consensus, essentially bottom-up EPS earnings per share model for 2021 into 2022, you can see that there's a lot of earnings momentum built into the estimates right now. And I think, again, if you talk about the opportunity, regardless of whether we have a little bit of a correction or sell-off or consolidation of gains in the market, that there's plenty of earnings power heading into 2022 that will provide, I think, the mother's milk for stock price appreciation. Not necessarily a lot of multiple expansion, but certainly, if you look at 12% year over year moving from 21 to 22 after plus 34% from last year to this year, that on a compounded basis translates with no multiple expansion whatsoever. It translates into a meaningful equity return. Now, an interesting chart that I came across in the weekly stack this week is the S&P 500 real earnings yield. And so we've talked about the market moving higher, the price index moving higher, and we've talked about earnings moving higher. But what's really interesting is that we see the real earnings yield, which is defined as the S&P 500 earnings yield less the change in the consumer price index. And, as we've seen this spike of inflation, obviously what we want to do in portfolios is to grow the portfolios well in excess of inflation. That's really our mandate, because we want real portfolio growth net of inflation. And what's really compelling right here is with the spike of inflation, despite the earnings growth that we've seen, we've actually had this little negative blip here in real earnings yield. And I think it's transitory. I think it's apt to pass. We'll get back to, as you can see here, going back to 1954, that there's a clear positive trend here, and the line of best fit is probably, somewhere close to about 3.5%, 3% perhaps. And we're well below that right now, but I do think we get back there at some point. All right, well, so now this actually goes back to the housing index and the housing update that I gave you. And so this is a Federal Reserve Bank of St. Louis graphic here, and it depicts on the purple line the house price index for the U.S. And the trend that we've seen here lately. We've obviously noted the spikes. It's been going up, frankly, in excess of the earnings capability for production and non-supervisory employees. And so this is an index that the Fed tracks. And so this kind of speaks to the affordability issue that I've been talking about, that has put a crimp on at least the younger generation and even that next generation up of people that are upwardly mobile, that are looking for new positions and perhaps wanting to relocate to different markets. And the housing price basket moving higher has actually challenged that somewhat. And you can see here that basically home prices are moving faster than incomes are. Here's an interesting chart that we get from Earnest Research, and we've talked a lot about household balance sheets being vastly improved, and that has actually been the case. We do know that student loan debt has really spiked. There's still a lot of student loan debt that's in forbearance for another few months. But this chart shows us that, interestingly enough, on the lower income cohorts, the ones who have been benefited most by the stimulus payments, that we still see credit and debit card spending going down. However, when you get into that upper income cohort, that plus $200,000 a year, that number is actually moving higher. So we're seeing consumption where we haven't. And over the last year, the net savings percentages moved dramatically higher, as some of these upper income folks would take the stimulus and bank it, or they just increase savings overall, whereas the lower income cohorts really couldn't do that, and they had to spend it. And now what's interesting is that you've got the upper income cohorts that are beginning to be more of a contributor into net spending, and that is definitely in evidence here. And as an indicator of what I call the jailbreak scenario, again, it's still a little bit subdued. That's the vacation intended index from the Conference Board, and this is a survey of many constituents, and I think we're apt to see this number move dramatically higher. And obviously you can see that there's a strong upward bias that was interrupted by the pandemic. And we're at a point now where I think, with more inventory, more TSA checkpoint data, again, we're not necessarily talking about business travel, we're talking about leisure. And this chart represents vacations intended. And even though it's subdued, I think it's apt to move considerably higher here in the coming months, heading into 2022. As we kind of conclude today, what I thought was really interesting, and this is from Statistica, a kind of a synopsis of where people feel like the threats are. And obviously we've had a change in administration. Rhetoric with China is very strong. We've got potential flashpoints with Iran that we're wrestling with now. And so this is a survey that was administered last February of about 1,000 adults. So and it's a Gallup survey. So it I trust that it has statistical significance in the way that it was administered. But what it shows here is we've got cyber terrorism, which we had the Colonial Pipeline incident where it was shut down and a ransom was paid. And I think that's an understated threat, but clearly in this survey, it had the highest rating. So cyber terrorism, use of computers to disrupt or drive fear, that's the highest risk as perceived by this constituency. And then development of nuclear weapons by North Korea and Iran. International terrorism remains relatively high. And interestingly enough, as we emerge from this pandemic, that the spread of infectious diseases throughout the world, only ranks kind of a distant fifth on this, if you will, or tied for fourth, I guess. And then, you get China, global warming, and then Russia, and then the Israeli-Palestinian conflict down below. But what's interesting, I think the key takeaway here is that cyber terrorism as a threat or a risk, and I think to an economic standpoint as well, is really taken center stage. And I think it's going to be something that we're going to be talking a lot more about at the end of this year, and we're going to be talking a lot more about it in 2022. Well, that will do it for today. I hope you've enjoyed the broadcast, and on behalf of all my colleagues at BKA Wealth, we hope you have a safe week, a wonderful week, and we'll talk to you again very soon.